Did you just look up from your lunch and say, holy, the market's down a lot? You just realized it, didn't you? And you're probably wondering what the heck is happening. Right now, I'm looking at my screen and I see the S&P 500 is down 1.83% at this point. It was down almost 2% at some point earlier today. Dow is down 575 points as we speak. The Nasdaq's down 2.5%. Those are pretty sizable moves. We haven't seen moves like that since April. Does that ring a bell? Well, you're probably wondering what's going on and why that happened. And when I tell you, you're going to not be surprised either, right? I said April. Well, that probably means it has something to do with tariffs. So the big news that came out today was, if you can even call it that, was President Trump threatened that China could be experiencing large tariffs anytime soon because he's not happy with the way that China is behaving. So we need to unpack that a little bit and figure out what exactly the president's talking about when he says sizable tariffs, right? So let's first start with where we are with China and tariffs right now, okay? So currently, there is a 30% base tax tariff on China, 30%. That's big, right? That's not small. But that's where we are today. But let's remember where that came from. That's part of a truce, a 90-day truce, which the US and China have. Okay, and that truce ends on November 10th. That's coming up pretty quickly, right? In about a month from now, actually a month from today is November 10th. And what happens if we don't have if we don't reach a positive outcome between now and November 10th? Well, the tariff goes back to where it was prior to that. And what was that tariff? 145%. Now, that's big. That's really big. We thought 30 was big. 145% is unrealistically large. And if you recall, back in the March-April timeframe, when President Trump first raised it to 145%, that's exactly what pushed the markets to their lows of the year. That exact number, okay? So I remember that. It was painful. And markets were already suffering, and that 145%, the announcement 145% just sent the market into a spiral. The good news is a couple days later, the president softened up a little bit, softened his tone, and said that he was going to have discussions with China, and the market quickly recovered. Remember that data point for the later part of this discussion, okay? So here we are, several months from then. Markets have recovered. Markets have been trading up. And I think people have pretty much accepted that we're in a new market regime where tariffs exist. And the markets, for the most part, have accepted the tariffs that we have. However, perhaps people have maybe gotten a little complacent and forgotten about that little clause about the 145% tariff on China. And the president was good enough to remind us of that just this morning. And you're seeing a response right now to that. So we have to ask ourselves a couple questions. Is that actually going to happen? Let's remember how the president likes to negotiate. Pretty much all of his negotiations. As they get close to the end, he turns up the heat significantly because he tries to exact the most amount of pressure on his opponent, okay? And that makes a lot of sense. But let's also remember it's coming from both sides because China has been turning up the heat a little bit too. So if we pay attention to some of the, the news items that really didn't, bubble up to the top in the last couple of weeks, there have been some signs that maybe things are not going as well as possible. I even saw a bunch of headlines this morning about that as well. So those things are out there, but I think people are choosing not to look at them. And so what happens is you end up in this period of complacency where the result of that complacency are usually large moves, okay? And so I want to talk for a second about the VIX index, right? So remember, the VIX index is the volatility index. It actually tells you where we expect the S&P 500. You could figure out where the S&P 500 would move in terms of volatility based on that VIX index. I want to cover that actually on a separate video so you can actually see, you can actually predict using the VIX how much the S&P 500 could move up or down any given day in any given time period. So the VIX index, when it trades up, that means the markets are volatile. When it trades down, that means markets are not volatile. If you take a look at the chart, I'm looking at the chart right here, you could see we had a huge spike up to over 50 in April, right? That's when markets were hitting their lows. That's when we learned about the first 145% tariff, right? But markets quickly traded back down. The VIX did, that is, below 20 in May, right? So markets calmed down, and that was the beginning of the market grinding up to a bunch of new all-time highs. I think we had 33 all-time highs this year so far. You're going to have to check me on that number, but it's there somewhere. And that's not a small amount. Given what's going on. It's not as big as it was last year and the year before, but it's still pretty respectable considering what we lived through earlier this year and what continues to go on. That said, if you look at the VIX, you'll see that it kind of traded down and for the most part stayed below 20 and right in that 15, 16 range. Now, that is not volatile at all. Now, it could trade lower than that. However, because of the fact that it's traded here for such a long time, knowing that we do have these headwinds, right? So we can't forget that there are some headwinds out there, right? The Chinese deal is not done yet. That's one big one, right? We know that there's a lot of geopolitical tension out there, not just with China. That's another thing. And let's talk about economic headwinds, macro headwinds for a second. We know that the labor market is weakening. This is a recurring story. We all know about this. This has been happening for some time. We have a Fed that is somewhat reticent to cut rates, despite the fact that the markets want the Fed to cut rates. So we have all these things happening. And we also have a government shutdown. We're in like day 9 or 10 of a government shutdown. I think it's 10 at this point. And so not only can that have some economic effects, but also from a trading perspective, we've been in a data blackout essentially for the last week and a half. Like we missed a very important number last Friday, one that is pivotal in the Fed's decision process. And we have a bunch of big numbers that are going to come out next week that if we don't resolve this shutdown, we're not going to get those either, right? So I'm going to talk about that in another video where I do the week wrap, where we'll talk about what we're expecting next week. But these things are playing into the market psyche right now. There are no data points to trade on. And basically, the one data point we got this week was the president threatening a 145% tariff on China on a Friday afternoon. And with a market that has traded with very low volatility for quite some time. Remember, earlier this week, just 2 days ago, we were making new highs. In fact, I want to point out the fact that, I think I put out a video earlier this week, which you should check out, where I was talking about not only gold hitting an all-time high, but the S&P 500 and the NASDAQ hitting all-time highs at the same time. It rarely happens, right? Because, gold hitting all-time highs is a hallmark of nervousness, of stress, while the S&P and NASDAQ hitting all-time highs is the complete opposite. So how can you hit an all-time high on both at the same time? Well, my friends, in this market, you can. And so I'd urge you to take a listen to that video. It's interesting. You'll learn a little bit about the history of that and what makes gold trade up and what it's been doing and why it might be trading over 4,000 at this point, which is a number that should in and of itself be astonishing. That all said, that was a perfect setup to where we are today. And like I keep saying, it's like a coiled snake. We have this high complacency of traders. You can see it in the markets. You can see it in the VIX, despite all the headwinds. And so now I want to talk a little bit about what's happening in the market. So I'm looking live at what we have trading off at this point. You see some chip companies. You see Synopsys is on the top of the decliners list. We see Coinbase, Block, Supermicro, ON Semiconductor, MCHP, Microchip Technologies, Zebra Technologies. You see these companies, you see Robinhood's there. You see these companies trading off a lot today. I mean, look, you see Synopsys is down like 7.7% as we speak. Looking at Robinhood, that's off 6%. That's a pretty sizable move. If you heard the names I just said, you know that there's a little bit of a theme here, right? So there are two themes working here, right? One, we have crypto, right? So crypto is obviously getting hammered today. Crypto is very much on the administration's agenda, and many people would argue that crypto had done very, very well this year because it's being propped up or helped with policy from the administration. That's getting hammered. That's not surprising at all. Seeing chip companies trade off is something a little bit different. It could be because there's a very tight relationship between chip manufacturing and China. So that's a very, very complex web of connections, trade connections that causes things like that to happen. So chips are getting a little bit of pressure. And of course, there was news earlier today that China's, their equivalent of their FTC is sort of looking at, putting some stops on NVIDIA. So, that stuff sort of playing into this now. But there's another important theme I want to cover here, right? Which is what you do in this type of situation with these stocks that you own. So if you look at the stocks that we talk an awful lot about, the stocks that we like, the mega cap stocks that have been really pulling the markets higher earlier this year, the AI type stocks, the chip stocks. We had a huge move in AMD the other day. We're seeing a lot of that happen. These are the stocks that most people like to own these days, and for good reason, because there's a lot of potential there. However, these stocks are high beta stocks. A beta basically shows you how a stock trades relative to the S&P 500, right? A beta over 1 means a stock is going to be more volatile than the S&P 500. So 1.5 beta means the stock is going to move 1.5 for every one move of the S&P 500, or it's going to move, 50% more than the S&P 500 moves for the day, right? That's a high beta stock. High beta stocks are awesome when the stock market is going up. But I like to remind people all the time that beta works in both directions. So when the market goes down, those high beta stocks, no matter what, are going to go down more than the market. So hopefully you're thinking right now, okay, that might be a buying opportunity. And if you are, you would be right. But you have to take one step more back, right? Because you got to be careful here, right? I like to talk about stocks that go down for the right reasons and some that go down for the wrong reasons. Now, there are probably plenty of stocks out there that are down for the right reasons. That means maybe earnings estimates are going down. That means management slip-ups. That could be a decline in earnings growth. All these types of things that may indicate that a company may not be so healthy in the coming quarters. However, if a stock is doing really well, and we see management on top of things, we see deals being announced, we see earnings estimates rising. Remember, we have earnings season starting next week. You see all these things that are giving you signs of health, and then you see a stock down 6% because the market's down 6%. And this stock might be a high beta stock, so it might be down 7%, right? So something like that. Stocks are going down more than the market when they shouldn't be going down. This, my friends, is a classic buying opportunity. But like I said, you have to be very, very careful, right? There's a lot of stuff going on. We do have headwinds. We're expecting a good earnings season. However, each stock is different and we never know what we're going to hear in that earnings season. So we have an interesting day today. Again, some news that woke traders up in a week of sleepiness where they have had no data to chew on a Friday. And we're talking big numbers, 145%. We're a month out from that November 10th, the end of that runway. And so to me, it seems rather natural that the market is trading off at this point. I also want to add bonds, right? So we want to look at bonds really quickly. Not surprisingly, Treasury yields are coming in. I see the 10-year at this point is down by 9 basis points, and the 2-year is down by 8 basis points. We want to just take away from that is this. On the 10-year, it's a regular, typical risk-off trade. That means people are buying treasuries. They may be selling stocks and buying treasuries as a safe haven in volatility, and that's pushing down 10-year yields. Remember, 2-year yields, they do that too, but not to as much of an extent, right? So to see the 2 years down 8 basis points, the 2-year is typically under the power of the Fed, right? It's closer to the Fed funds rate. So basically what that's telling me, and I'm going to actually take a look at it right now, is that it's possible that folks are expecting, as a result of the volatility, that possibly would increase the probability of more rate cuts between now and the end of the year. So I'm going to take a look at that right here live. I'm going to look at Fed funds futures, and I'm going to see how they've traded before today. And I can see that just based on today that, okay, I would say there was, so prior to this morning, basically what we were talking about was we're talking about 100% chance of one more 25 basis point rate cut between now and December. And this morning, there was an 80% chance of a second rate cut. So, 50 basis points between now and the end of the year. That's the general consensus. First of all, I want to say 80% for stock market is pretty good odds. But now, after today's news, there's now a 91% chance. So the odds of a second rate cut have gone up, 10%, between 80% to 90%. So that probably explains a little bit of why the 2-year is trading higher at this point. But all these things are interesting. Frankly, the market is behaving as one would expect the market to behave. Like I said, right now, it looks like the S&P is improving a little, down by 1.76%. That's still a crappy day. Let's remember last time we had days like this, again, we're earlier in the year. We thought all that was behind us, but it wasn't, because the reality is that the troubles that we had back in April are still with us, and they may come back to bite us in the where on November 10th. So that's your quick update of what's going on. I'm going to let you get back to eating your lunch, but I want to let you know that if you like this type of content, click the like button, subscribe, because we don't want you to miss any of this stuff, because we're putting a lot of content out every single day. You're going to get some very interesting stuff over the weekend, so come back for more. Thanks for checking in with Wall Street Truth Bombs. Remember, we drop them here before the market figures them out.